If you decide to wait until you are 30 to start investing, you are not just losing 10 years of time, you are effectively agreeing to cut your future net worth in half. I know that sounds like an exaggeration or some scare tactic cooked up by a financial advisor trying to sell you a product, but it is just cold, hard mathematics. There is a specific window of time in your life, specifically that decade between age 20 and 30, where your money has a superpower that it will never, ever have again. It is the ability to multiply effortlessly while you are sleeping. If you miss this window, you can certainly catch up, but it is going to cost you 4 times as much money and twice as much stress just to get to the same starting line. Today, I'm going to walk you through exactly why starting at 20 is the single most profitable decision you will ever make, and how to do it even if you feel like you have absolutely no money to spare. You see, most people view their 20s as the time to be broke, to experiment, and to figure things out. And while I am all for experimenting, being financially illiterate during this decade is a mistake you will pay for in your 60s. We are going to look at the compounding math, the psychology of risk, and the massive safety net you build when you start young. If you appreciate deep dives into the mechanics of wealth without the hype or the sales pitch, do me a favour and subscribe to the channel. It tells the algorithm that financial literacy matters. Now, let's look at the engine that drives this whole machine: compounding. It is a word you hear constantly, but very few people actually understand just how aggressive the curve really is. Compounding is often called the eighth wonder of the world. The concept is simple enough. You earn returns on your money, and then next year you earn returns on your returns. It sounds boring on paper, but here is the thing about compounding that our brains are not wired to understand. It is not linear. It is exponential. In the beginning, it feels like pushing a boulder uphill. You invest $1,000, you make $70. It feels pointless. You wonder why you didn't just spend that grand on a weekend trip. But the magic happens when the snowball rolls long enough. The returns generated in year 30 or year 40 of an investment often exceed the total amount of money you contributed in the first place. The earlier you start, the longer that runway is. When you start at 20, you are giving your money 45 years to snowball. That is a massive advantage that a billionaire starting at age 50 simply cannot buy. Time is the one asset that levels the playing field. Let's put some real numbers on this, because this is where the gap becomes terrifying. Let's say you start investing $200 a month at age 20. Assuming a standard 7% annual growth rate, by the time you are 65, you have roughly $760,000. That is nearly $750,000, mostly from just $200 a month. Now, let's look at your twin. They wait until they are 30 to start. Same investment, same $200 a month, same 7% return. But at age 65, they only have $368,000. They didn't do anything wrong, they just started 10 years later. But that 10-year delay cost them nearly $400,000 in final wealth. If you wait until 40, that number drops to $174,000. The difference is staggering. It is the same monthly effort, but the result is slashed by more than half simply because the clock started ticking later. That is the price of procrastination. One of the biggest mental blocks I hear is, "Tom, I'm 22, I'm making entry-level wages, I barely make rent, how am I supposed to invest?" And that is a fair point. But the industry has tricked us into thinking investing is for rich people in suits. The reality is that consistency matters infinitely more than size when you are young. Because of that time factor we just discussed, $50 invested at age 20 is worth more than $100 invested at age 35. You do not need thousands. You need 25 or $50. If you can skip 2 takeout meals a month, you have enough capital to start a 6-figure portfolio. It is not about the amount. It is about establishing the habit and getting the clock running on those dollars. The other secret here is that you won't be broke forever. Hopefully, your income will rise. If you build the infrastructure now, opening the account, linking the bank, setting the auto transfer for $50, it becomes effortless to scale that up later. When you get a raise at 25, you just change the setting from $50 to $200. If you wait until you have enough money to start, you will find that you never actually feel like you have enough. Lifestyle creep will eat your raises, and you will be 35 wondering where the money went. By starting with micro amounts now, you are building the container for your future wealth. The money itself is almost secondary to the behavior you are programming into your brain. Here is a twist that people often miss. Having no money actually gives you a massive strategic advantage. When you are young, you can afford to be wrong. In the investment world, risk and return are correlated. Generally, to get higher returns, like with stocks or crypto or startups, you have to accept high volatility. Prices will crash. If you are 60 years old and retiring next year, you cannot afford for the market to drop 40%. You have to play it safe, which means lower returns. But at 20? If the market crashes 40%, it doesn't matter. You aren't touching that money for 4 decades. In fact, a crash is good for you. It means you are buying shares on sale. You have the luxury of time to recover from economic storms that would ruin an older investor. Think about it like this. If you lose money in the market at 22, you have 40+ years to make it back. History shows us that over any 15 or 20-year period, the stock market has generally gone up. By starting young, you can allocate your portfolio to aggressive growth assets, things that swing wildly but trend upward over time. You can ride out the dot-com bubbles and the housing crashes. This allows you to capture much higher average returns than someone who starts at 45 and has to hold bonds because they are terrified of losing their principal. Your youth is a hedge against market volatility. You are essentially insurance for your own portfolio just by being young. Now, let's pivot for a second. I know retirement feels like a fake concept when you are 20. It feels like talking about what coffin you want to buy. Who cares about age 65? I get it. But investing early isn't just about being an old person with money. It is about buying freedom in your 30s and 40s. This is what we call financial flexibility. If you start investing at 20, by the time you are 30, you might have a portfolio worth $50,000 or $100,000. That money changes the way you navigate life. It means if you hate your boss, you can quit. If you want to take a year off to travel, you can. If you want to start a business, you have your own seed capital. Investing is not just locking money away until you die. It is building a platform that allows you to take risks with your career and your life choices. Imagine 2 people at age 32. One has 0 investments and lives paycheck to paycheck. The other has $100,000 in a brokerage account. An amazing opportunity comes up, maybe a chance to move to a new city for a lower paying but more fulfilling job, or a chance to buy a fixer-upper house. The person with 0 assets has to say no. They are trapped by their monthly bills. The person with the portfolio can say yes. They can liquidate a portion of their assets or borrow against them. They have options. That is what you are buying with that $50 a month at age 20. You aren't buying a retirement home. You are buying the ability to say no to things you hate and yes to things you love 10 years from now. We have to talk about the villain in this story: inflation. If you decide to just save your money in a shoebox or a standard checking account, You are actively losing wealth every single day. Inflation is the rate at which prices rise, and historically it averages around 2 to 3%, though we have seen it go much higher recently. If inflation is 3%, your cash loses half of its purchasing power every 24 years. That means a dollar saved at 20 buys 50 cents worth of groceries when you are 44. If you are not investing, you are standing on a treadmill that is moving backwards. You think you are staying safe by holding cash, but you are actually bleeding value. Investing is the only reliable shield we have against this erosion. To beat inflation, your money needs to grow faster than prices rise. Savings accounts rarely do this. Investments, like stocks, real estate, or index funds, have historically produced returns that significantly outpace inflation. Over the last century, the stock market has returned about 10% on average. Even after you subtract inflation, you are looking at a real return of around 7%. That is the difference between your money dying and your money growing. By starting at 20, you ensure that your purchasing power isn't just maintained, but expanded. You are ensuring that 1 hour of your labor today can buy 2 or 3 hours of someone else's labor in the future. That is the fundamental definition of building wealth. Here is the easiest return on investment you will ever find. And it is tragic how many young people ignore it. I am talking about the employer match. Many jobs offer a 401k or similar retirement plan where the company matches what you put in, usually up to a certain percentage of your salary. Let's say they match 50% of your contributions up to 6% of your salary. If you put in $1, they give you 50 cents. That is an immediate, guaranteed 50% return on your money. You cannot get that in the stock market. You cannot get that in real estate. It is literally free money sitting on the table. If you don't take it, you are effectively agreeing to be paid less than your co-workers who do take it. Beyond the match, starting young allows you to maximize tax-advantaged accounts like the Roth IRA. The Roth is particularly powerful for young people. You pay taxes on the money now, when you are likely in a low tax bracket because you are just starting your career. Then, that money grows tax-free for 40 years. When you pull it out at retirement, you pay 0 taxes on the growth. Think about that. If you turn $10,000 into $1 million over your lifetime, the government doesn't touch a cent of that $990,000 of profit. That is a legal tax haven available to almost everyone. But it works best when you start young. If you wait until you are earning a huge salary in your 40s, you might earn too much to even contribute to a Roth, or your tax rate might be too high for it to make sense. Let's shift gears to the psychological side. Investing at 20 isn't just about the math. It's about habit formation. If you get used to spending 100% of your paycheck at 20, it is going to be incredibly painful to start saving at 30. You will have built a lifestyle that requires every penny you earn. But if you start investing immediately, even a tiny amount, you learn to live on slightly less than you make. You treat investing like a bill that must be paid, just like rent or Netflix. By automating this, setting up a direct deposit straight into your investment account, you remove the willpower from the equation. You don't have to decide to be disciplined every month. It just happens. And that habit, once set, is very hard to break. Starting young also gives you time to find your investing philosophy. You are going to make mistakes. You might buy a stupid meme stock. You might panic sell when the market dips. It is much better to make a mistake with $500 at age 21 than with $500,000 at age 50. You pay your tuition to the market early when the stakes are low. You learn your own risk tolerance. Do you lose sleep when your portfolio drops 2%? You will find out. These lessons are invaluable, and you simply cannot learn them by reading a book. You have to have skin in the game. The earlier you start, the more seasoned and calm you will be when you are managing real wealth later in life. There is also a massive mental health benefit to this. Financial anxiety is one of the leading causes of stress in the modern world. It ruins marriages, it causes health problems, and it keeps people up at night. When you start investing early, even if the numbers are small, you gain a sense of control. You know you are doing something. You see that number ticking up slowly. It creates a psychological safety net. You realize that you are not entirely dependent on your next paycheck. That feeling of agency is powerful. It allows you to walk through life with a little more confidence and a little less desperation. On the flip side, the most common regret I hear from older people, almost universally, is, "I wish I had started earlier." Nobody ever says, "Man, I wish I had waited until 40 to open that IRA." The pain of looking back and running the numbers on what you could have had is real. By starting now, you are protecting your future self from that regret. You are being kind to the person you will be in 20 years. It is an act of self-care. You are gifting your future self options, security, and freedom. And trust me, your future self will thank you for it. I want to quickly address the barriers because I know they feel real. We talked about not having enough money, and we debunked that you can start with $20. The other one is investing is too risky. Look, keeping your money in cash is risky because of inflation. Putting it under your mattress is risky because of fire or theft. Everything has risk. Investing in a diversified index fund is actually one of the safest bets over a long timeline. The risk of the entire global stock market going to zero and staying there is basically the risk of the apocalypse, at which point your money won't matter anyway. The biggest risk isn't the market crashing. The biggest risk is not participating in the growth of the economy. The other barrier is debt. I have student loans. I should pay those off first. This is nuanced. If you have high interest credit card debt at 20%, yes, pay that off immediately. That is a guaranteed 20% return. But if you have student loans at 4 or 5%, it usually makes mathematical sense to invest simultaneously, especially if you are getting an employer match. Do not walk away from a 100% match return just to pay down a 4% debt a little faster. You can do both. Pay the minimums on low-interest debt, get the match, and start building your asset column. Do not let debt paralyze you into inaction. So, here is the bottom line. The smartest investors in the world are not necessarily the ones with the highest IQs or the best complex spreadsheets. They are the ones who let time do the heavy lifting. You have an advantage right now at age 20 that Warren Buffett does not have. You have time. You have a long runway ahead of you. You can turn small, insignificant amounts of money into life-changing wealth simply by waiting. But that advantage is a melting ice cube. Every year you wait, the difficulty setting on building wealth gets turned up a notch. Don't play the game on hard mode. Start now while it's easy. You don't need to be perfect. You don't need to time the market. You just need to start. Open the account, set up the transfer, and get back to living your life. Your future self is waiting for you to make this move. If you found this breakdown helpful, or if you want to share your own "I wish I started earlier" story, drop a comment below. I read as many as I can. Thanks for watching, and I'll see you in the next one.